when everybody rushes toward gold and silver as a monetary asset to protect their wealth. And so it's going back into the triple digits soon. And in fact, all of these big banks, Bank of America, Goldman Sachs, Merrill Lynch, they're all projecting silver at 90 and 100 and 150 and even $300 an ounce.
Mm-hmm. China imported more silver in the first 3 months of the year than at any time in the history of the country. And here we just see in February, largest gold and silver deliveries, largest gold delivery, and the 39 million ounces leaving COMEX as the price got its teeth kicked in. In other words, the biggest money in the world is using price as to run cover for physical accumulation.
Quick favor before we begin: if you enjoy this video, don't forget to like and share it. Every like and share helps YouTube recommend this video to more people, which really helps the channel grow. Could silver be on the verge of a historic breakout? Major institutions are forecasting triple-digit silver prices, and demand for physical precious metals is drawing close attention as investors watch a possible major market story unfold. Mike Maloney and Andy Schectman examine developments shaping the gold and silver market as investors increasingly seek safe haven assets during economic uncertainty. Schectman argues that growing demand for physical precious metals is creating pressure on available supplies, potentially setting the stage for major price movements. He highlights forecasts from leading financial institutions, including Bank of America, Goldman Sachs, and Merrill Lynch, which suggests silver could eventually reach $90, $100, $150, or even $300 per ounce. Schectman also points to record silver imports by China, substantial COMEX gold and silver deliveries, and ongoing withdrawals from exchange inventories as signs of strong physical demand. He argues that large institutional investors may be accumulating precious metals while prices remain relatively subdued. Maloney emphasizes that market prices do not always reflect underlying fundamentals, and that temporary price weakness can conceal powerful long-term buying trends. The discussion explores silver price predictions, gold market trends, precious metals investing, supply and demand dynamics, inflation concerns, and wealth preservation strategies. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Silver is destined for triple digits, and then I was being called crazy. One guy said it was coke-induced nonsense.
What was the price at that point?
I think it was about $14 or something like that.
So that was a big prediction.
Yes, it was, but it hit $122 in January. It's pulled back, but this is temporary. We're in a structural deficit where every year there's more silver being used up than there is being mined, and the above-ground stockpiles are shrinking more and more and more just when demand is taking off. You can't have AI without silver. It's not possible. So we've got solar panels, electric cars. The demand for silver is exploding at a time when the supply has been collapsing. And one thing that most people don't realize, 2/3 of the silver supply comes as a byproduct from mining copper, lead, zinc, and gold. Well, gold, that's not very much of it. Most of it is copper, lead, and zinc. And if the world goes into an economic slowdown, which it should here, because the whole bunch of the energy capacity of the planet, the production of energy, oil, has been shut off with this war. And if you look at GDP and energy consumption track each other almost perfectly. So if you've got less energy available, it means that the global economy has to shrink. If the global economy slows down or shrinks, then there's less copper wire for houses, there's less cars being built, and a whole bunch of the production of copper, lead, and zinc goes away, and with that, silver supply goes away, just at the time that you've got a crisis when everybody rushes toward gold and silver as a monetary asset to protect their wealth. And so it's going back into the triple digits soon. And in fact, all of these big banks, Bank of America, Goldman Sachs, Merrill Lynch, they're all projecting silver at 90 and 100 and 150 and even $300 an ounce. And so they are now saying what I've been saying for about 10 or 15 years. So, welcome to the party, Goldman Sachs. So, yeah, it is destined for these, I believe. Now, none of this is investment advice. I don't give advice. I only tell people what I do. And for me, more than half of my net worth is stored in silver. Well, the 1970s, there's a lot of similarities. We had a crisis in the Gulf. We had the Iran hostage situation. We had the Arab oil embargo, which is similar to the supply that we have just destroyed with the closure of the Straits of Hormuz, and then the damage to infrastructure that's going to take 3 to 5 years to repair. And we haven't seen those consequences yet flow through to the stock market. In the 70s, the dollar had only been a fiat currency, disconnected from something solid and real that backed it, gold. That happened August 15th of 71. And so gold rose it was $35 an ounce. It went to just a whisker away from $200 an ounce, pulled back during 74 to 103. It went into a bear market. There was an 18-month bear market, a year and a half, in late 76, I believe it was. And then it took off like a rocket and went to 873 was the actual intraday high in January of 1980. But that was against a backdrop of super high inflation, and we're not there yet. So gold went into this blow-off top that was quite amazing. It hit about $400 an ounce in late 79, and then in just 3 trading weeks it went to 873. Just absolutely spectacular. And to that date, that was the greatest bull market in history. And today, we don't have the high inflation. What we have, though, is rampant currency creation. The Federal Reserve has tipped their hand. Everybody knows what their response is to a crisis. Take short-term interest rates down to 0, and you don't print anymore, you type. Yeah. And the difference between 1 and 1 trillion is 12 zeros. It doesn't take a whole lot. The whole currency scam, the whole currency system, I don't call it a monetary system because it has nothing to do with money. There's a difference between currency and money. But it is a scam, and it's all backed by your future tax.
China imported more silver in the first 3 months of the year than at any time in the history of the country. And here we just see in February, largest gold delivery, and the 39 million ounces leaving COMEX as the price got its teeth kicked in. In other words, the biggest money in the world is using price as to run cover for physical accumulation. And when I tell you that less than 1% of contracts ever stood for delivery, I'm dead serious. In February, almost all the contracts that posted stood for delivery. I don't know the number, but it is much, 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 much longer or bigger. And I would just simply say that these people are the most well-informed traders on the planet. And at 9 figures every month for going on over a year and a half, these people don't screw around. The ETF metal is being tapped as a source of ready available supply. What I mean by that is that when physical demand rises and large quantities stand for delivery, like we've been seeing on COMEX, authorized participants have the ability, and those would be those that fund the baskets like Goldman and JP and Citi and B of A. They can redeem ETF shares very quietly. And they take possession of the underlying metal and they use it to satisfy delivery obligations or replenish inventories or move it to COMEX warehouses or ship it to buyers elsewhere in the world. In that sense, ETFs can become a source of physical supply during periods of tightness. And so when we talk about ETF draining, it isn't always as it seems. In other words, shares were sold off. Well, what if it's Goldman Sachs saying, we want the physical, let's not make the big footprint that we otherwise would on COMEX. Let's just redeem 10,000 shares and stamp for delivery. Okay. And they do that all the time.
Silver is back in focus as investors debate whether the metal can break back into triple digits. This interview explores the case for a major silver move, from shrinking above ground stockpiles to growing industrial demand across AI, solar panels, electric vehicles, electronics, and energy infrastructure. It also looks at why silver supply is unusually vulnerable, with much of global production coming as a byproduct of copper, lead, zinc, and gold mining. When economic slowdowns reduce base metal production, silver output can fall even as demand continues to rise. That imbalance is the core of the bullish argument. The conversation connects silver prices, energy markets, inflation pressure, global growth, mining constraints, and the possibility of a long-term structural deficit. For anyone following precious metals, commodities, or macro investing, This segment offers a clear look at why silver remains one of the most watched markets today, especially as demand accelerates and global supply struggles to respond quickly. Let's get back to the interview.
There's a difference between taking delivery and leaving COMEX. In the last 30 days, roughly 1 million ounces has got up and left COMEX. And so, there's a difference. Now, you can have it delivered into the COMEX ecosystem. There's two different, there's registered and there's eligible. Registered are the bars that are backing the contracts and that have been rehypothecated. But eligible, we have 9 Brinks vaults in our storage program. They're all with Brinks and throughout North America. One is in New York City. It is the only one of the 9 that is a COMEX depository. So I have, as an example, let's say I have a client who has 1 million ounces of 1,000-ounce silver bars. In that Brinks facility, it is a COMEX facility. Those are eligible. They are not for sale. They could be transferred to registered, but they are eligible, and she just leaves them there. So when metal gets delivered to COMEX, doesn't mean it leaves COMEX. Now, it's important to understand, Dan, that I've been doing this for now 36 years, and if we look at the first 34, less than 1% of contracts would ever stand for delivery. In other words, give me the numbered bars, please. I just want the paper settlement. When you see, now this has been going on for 18 straight months. 18 straight months since Trump won the election. Every single month, we have seen billions upon billions upon billions upon billions upon billions delivered, and it has been completely missed by the mainstream. Nothing else matters to me. Everything else is misdirection. Everything else is just noise. When the most well-informed traders on the planet are standing for delivery in ways that we are seeing here, not just here in the United States, which we can talk about, but that is an anomaly in every sense of the word. It is not weakness. It is accumulation under the cover of falling price, which is a tool of misdirection. Sure, pullbacks are very uncomfortable, but they do not change the thesis that gold and silver are real value. They are not someone else's promise to pay, and that's why they matter. You look at China, they've been buying for 19 straight months. They bought 10 tons of gold in May, the largest monthly addition in over 18 months. This follows the 8+ tons they acquired in April. That's making their 19th consecutive monthly net purchase. But we can also talk about silver. I'll give you an example. In December of 2025, COMEX set a single month record with 65 million ounces delivered. In January 2026, 49.4 million ounces delivered, more than 7 times January 2024's level. All of 2025 combined settled 474 million ounces, right? So when you talk about how much more has been delivered recently, let's just look at 2026. In February 2026, 25.1 million ounces were delivered. That was the highest February on record, making it the highest 2-month delivery rate in exchange history. But 39 million ounces in February, about 2.9 million pounds, got up and left COMEX. They got on trucks, $4.5 billion worth got on trucks. Someone ran logistics, someone ran insurance, and drove away. 2.9 million pounds of silver worth $4.5 billion. And where is the mainstream media saying, who the hell is doing this? March 2026, 10,526 contracts deliver. That's 52.63 million ounces standing for delivery. And here we are in June, still early, about 2,200 contracts or so have already delivered. But let's just say from January to May 2026, we've seen 169.3 million ounces of silver physically delivered. And when you talk about that kind of volume, from January to May of this year, we're already 45% above the entire 2023 full year's worth of deliveries in just 5 months.
Gold and silver that you can hold in your hand, and it's highly liquid because all of the precious metals dealers have accounts at Brinks, and so when you go to sell it, you don't have to take delivery of it, you don't have to ship it anywhere.
No, they just move it around.
You're changing title to it, basically.
That's
you sell it back to a dealer, and you've got cash in like 48 hours. It's actually more liquid than the average stocks. Now, regarding ETFs, the reason I don't hold anything like an ETF, you can short SL SLV, and you can short GLD. Okay, when you short a stock, if your account is margin enabled, you have given the brokerage house the right to go in and borrow your shares and sell your shares to somebody else without telling you. You think you own those shares. Somebody else also owns those shares because the short seller sold them to him. And the same thing happens. You've got an ounce of gold or an ounce at GLD or an ounce of silver at SLV. The brokerage house will borrow those shares that represent those ounces, loan them to a short seller at interest. The short seller sells them into the market, and somebody else owns the same ounces that you own. Two people own the same ounces. There is never a condition that the ETFs are in where all of the ounces are solely owned by a single, where each person owns all of the ounces that they think they own. I just view them as another scam. Wall Street just plays a shell game with everybody, and they always win.
I remember Chris Martinson said, physical, you got a gold in your hand, but the ETF is paper. A lot of electronic traded funds, ETFs, are paper. They're a derivative of the actual real thing.
Yeah, you need to read the 10K filings and their prospectus and stuff and realize these things are written by armies of the best attorneys on earth, and then analyze every sentence separately. And what you'll see is that you think they're saying something to you, but when you really analyze it, they're either saying the exact opposite, or they're saying two different things, or they're saying nothing. That sentence actually means nothing when you look at it, and all they have to do is add a comma here. It's really interesting how these things are written. At the end of the day, it's not supposed to be paper. It's supposed to, what they're telling you is, this is really physically backed, but when you read it and analyze it, they don't have to.
Yeah.
They can use futures and options and things like that to mimic the price of gold and silver.
What happens when the signals most investors ignore today become the headlines everyone is talking about tomorrow? That is often how major market shifts unfold. The biggest opportunities and most important trends rarely announce themselves in advance. Instead, they develop quietly in the background while attention stays fixed on short-term price action and daily news cycles. History has shown that markets move in phases, and those who understand the broader picture are usually better positioned when the next chapter takes shape. Whether the coming months confirm current expectations or deliver a different outcome, one thing remains certain. Staying informed and following the underlying trends matters far more than reacting to every headline. The financial landscape continues to evolve, and investors who focus on knowledge, perspective, and long-term thinking are often the ones who navigate uncertainty with the greatest confidence. As new developments emerge, the story will continue to unfold, and the smartest approach is to remain attentive to the signals that truly matter. If you enjoyed this analysis, be sure to like this video, subscribe to the channel, and turn on notifications for more market insights, economic updates, and in-depth discussions. Thanks for watching, and we'll see you in the next video.